If you're waiting for the perfect opportunity to refinance, you might have already missed it. But here's the thing, it's not too late to take action so that if and when rates drop again, you're in the best position possible to take advantage of them. As you know, rates were going down until suddenly they weren't. We actually saw interest rates move to the lowest level that we had seen since February of 2023. And then all of a sudden, they shot up to the highest level that we had seen in nearly 3 months. So what's really going on? Is there going to be another opportunity to take advantage of lower rates? In this video, I'm going to break down what's happening now, what experts are predicting, and how you can still take advantage of refinancing without getting left behind. Let's imagine interest rates are going down, you're holding off, and then just when you're ready, boom. In fact, that's what happened to a lot of people out there. They were actually waiting to see what the Fed was going to do with the federal funds rate. And as the Fed came out and announced that they were going to drop the Fed funds rate 50 basis points, the market actually moved the other direction. And unfortunately, this happens more often than you think. See, a lot of people out there are waiting for things that they're hearing in the news to actually happen, when in fact, a lot of those things are already priced into the interest rates that you're seeing at that time. And because of that, the window to refinance can open and close very quickly, especially with recent fluctuations. See, understand there's a lot of volatility out there in the market at the moment. Economic data, the Fed, the election, and all of those things have an impact on interest rates. And that's why in any given day, interest rates can move anywhere between 1/4 and 0.5%. But here's the thing, if you're proactive, you can actually avoid overpaying while taking advantage of these opportunities. So what are experts actually saying about where interest rates are headed? Fannie Mae predicts that interest rates will average about 5.9% in 2025. Interestingly though, they break down their predictions by quarters as well. And by the fourth quarter of next year, they're thinking that interest rates are going to be somewhere around 5.7%. At the same time, Freddie Mac has come out with their predictions, remaining really cautious, only saying that they believe interest rates are going to remain above 6% for the rest of the year. Now with that, they do believe that mortgage rates should fall, and with that, you're going to see a jump in mortgage applications. At the same time, the National Association of Home Builders is seeing an average rate around 5.8% in 2025. And with that, they see the 10-year actually falling to somewhere around 3.53% during that same period. But here's the thing that you need to consider. None of these forecasts expect interest rates to drop significantly by the end of 2024. All of them are expecting interest rates to remain well above the lows that we saw just a couple of weeks ago. So if you're someone out there thinking that you're going to refinance, you're someone that has an interest rate above 6.5%, 7%, or maybe you bought at the highs where interest rates were above 8% and you didn't take advantage of refinancing, then my best suggestion for you is to reach out to a mortgage professional now and start having that conversation. Find out where you need to be rate-wise for it to actually make sense. Find out what costs are involved, and keep in mind, this doesn't mean you have to do anything at this time. In fact, what you want to do more than anything else is just get on their list so that if and when rates drop to the level that you decide actually makes sense, they can actually reach out to you and have that conversation versus you having to watch interest rates every single day. Now, many of you know my story. I actually bought a house about a year ago and my interest rate was around 7%. And fortunately, interest rates dropped about a month and a half after I purchased that home. So I was able to take advantage of a refinance and lower my rate to 6.5% at that time. And dropping my interest rate 0.5% saved me just over $400 a month, which is a huge savings. But here's the thing, because I'm someone that follows interest rates every day, I'm watching the market every single day. When I saw rates hit really close to those lows before the Fed funds meeting, I reached out to my mortgage professional and asked if I could refinance again. And they said yes. And because of that, I was able to take advantage of a 6% interest rate less than a year from purchasing my home. So I refinanced 2 times in 1 year without any closing costs at all. And that's because I took an interest rate slightly higher than the best interest rate out there, which gave the lender enough yield spread to actually cover my closing costs. They gave me a credit back to cover those costs. Now, the reason I bring this story up is because I was following rates every single day. I'm watching them in the morning, I'm watching them in the afternoon, just so that I can advise my clients on what's happening out there in the market. And because I do videos like this. But I know most of you aren't able to follow what I'm following. And even if you can, some of the data doesn't actually make sense. So instead of causing stress, angst in your life of worrying about where interest rates are, just go to a mortgage professional, have that conversation now, and tell them that you want to get on their list. Now, my team here has created something called the Rate Watch, which is where you can go and fill out your information, tell us where your rate is now, what interest rate you're trying to go to, and when interest rates get there, we'll actually reach out to you. Now, if that sounds like something you might be interested in, check that link in the description of the video. Now, something I want you to be aware of, interest rates can move up just as fast as they move down, and sometimes even faster. Actually, if we go back to early August, refinance applications soared as mortgage rates went down. But as you know, that trend quickly reversed as mortgage rates shot up right after the Fed announced their easing of the monetary policy. Now, I realize a lot of you watching this video were actually waiting for that Fed cut to happen, thinking that interest rates could move down even more. And as I've discussed in earlier videos, a lot of that was priced into the market. But what wasn't priced into the market is everything that happened after interest rates started moving up. We got better than expected jobs numbers, we got consumer confidence going up, jobless claims had reached some of the lowest levels that we had seen in months, along with inflation coming in higher than expected. On top of this idea that if we get a sweep in the presidency along with Congress, that it's going to be super inflationary. And the bond market didn't like any of this, which in turn caused interest rates to jump nearly 1% from the lows that we saw just a couple of weeks ago. And a lot of this could have been avoided by not trying to pick the bottom in interest rates and actually moving forward when the numbers actually made sense. And that's because a lot of homeowners actually overlook the things that they should actually be paying attention to. Factors like timing, break-even analysis, as well as looking at the savings right now versus what they could be in the future. See, unfortunately, what happens with a lot of people is as they see interest rates move down, as they see prices move down, they get scared. Or they get anxious, they get excited and want to wait and they want to see them move lower. So they sit on the sidelines thinking that the trend is going to continue. And because of that, a lot of people miss out because what happens more often than not is things shoot up the other way really, really quickly. You've heard me tell the story many, many times about clients that I had that sold their property back in 2019 with this idea that the market had peaked and that in the near future they were going to be able to buy a property, something bigger than what they had for less money than what they owed on their current property. And we all know how that story ended. Prices are up nearly 40% since that time. And those people have never done anything. And the reason is because they were waiting for the perfect opportunity to do something. And I'm going back to my example that I used earlier. I refinanced 2 times within a year. Now, I could have waited and just waited until interest rates got down to 6% and not done the 7% to the 6.5%. But for me, it saved me $400 per month. And it took nearly 8 more months for interest rates to drop from 6.5% to 6%. And during that period of time, I saved $3,200. Now, of course, I could have just waited, but I would have missed out on those savings. So my best advice to you is that if you can refinance and take advantage of it now, you should do it as long as the break-even analysis makes sense. Now, if you can get someone to give you a no-cost refinance where it's not costing you any money at all, then you should absolutely refinance every time you can do it, as long as it makes sense. But on the flip side, if you're paying some cost to refinance, what you need to do is figure out how much money you're saving by refinancing, divide it into the cost of that loan, and figure out how many months it's going to cost you to break even. Now, in the current environment that we're in at the moment, because I do believe interest rates are going to continue to trend lower, if your break-even point is over 18 months, over 2 years, I don't know that it actually makes sense to refinance at that time. And the reason for that is I do believe interest rates are going to continue to come down to give you an opportunity to potentially take advantage of the rate that you're likely getting by refinancing and paying those costs now at some point in the future without having to potentially pay those costs. And of course, if your break-even point is 3, 4, 5 years, that's not going to make sense for most people out there. And I definitely wouldn't be one of those people out there at the moment buying down my interest rate, paying points to buy down a rate, unless, for example, I wasn't going to have a job in a year or 2 years. I was retiring and I no longer was going to be able to qualify for that loan. If you're still working, you're still going to be able to qualify in the next couple of years. My suggestion is not paying a bunch of points. Don't pay a bunch of fees to someone to refinance, and absolutely do not let them build that cost into your loan. Now, the typical advice from most professionals out there is that you need to see interest rates drop 0.5%, 0.75% for it to actually make sense to refinance. And that's simply not true, because it's all going to depend on your loan amount. Because the higher loan amount that you have, the less you actually need to save in interest rate for it to make sense. So my lender has this little formula that he uses that actually has a really weird way of working. We don't know why it works, the science behind it, but it does work. And that's that you take $125,000 and you divide it into your loan amount. So if your loan amount is only $125,000, 125 divided into 125 means you need to save at least 1% on that loan for it to make sense. Now, all of this stuff is going to come down to cost. If you're paying a bunch of fees, a bunch of cost to do it, then it's probably not going to make sense. This is for a 0-point loan. So don't just take this formula and run with it. Have a lender break it down for you. Have them show you what you're being charged. Compare it, to other lenders if you shop around, and just get a side-by-side comparison. Don't just take it and run with it. But if you take that 125 and you divide it into 250,000, for example, say that's your loan amount, then you need to save about 0.5%. And if you have a $500,000 loan, that means you need to save about 0.25%. A $1 million loan, you need to save about 0.1%. In the case of my example earlier, I have a $1 million loan. So in the case that I had a 7% interest rate, if interest rates had dropped to 6.875, that's 0.125%. Yes, it would have saved me about $100 per month. But in my case, it probably wouldn't have made sense to refinance because of the time, effort, energy it takes to actually refinance. Me personally, I would want to see more savings than $100 per month in order to go through that process. So just because the formula works doesn't mean you should take advantage of it. It actually has to work for you. Now, if you're somebody that is considering refinance, you missed the boat, maybe you're waiting on something else. What are you waiting on? What interest rate are you waiting on in order to refinance? I would love to know. Do me a favor and let me know in the description of this video. Now remember, the sooner you act by figuring out where you need to be for it to make sense, the better off you're going to be long term. That's why I'm going to re-emphasize the importance of talking to a mortgage professional now, having that conversation, and getting on their rate watch list so that when interest rates do go down to the level that you need to see them to refinance, they can actually reach out to you and you're not having to follow interest rates every day. Now, if you are somebody that is going to refinance in the future as mortgage rates come down, then you absolutely need to be very, very careful of how lenders hide the cost of the refinance. In fact, I've filmed a video on it that you can watch right here.